Hi, this is Brandon Bischoff with Canterbury Investment Management, and this is the video version of our weekly market update. So I'm going to start by reminding you what a Canterbury market state is. So the S&P 500 is currently in market state 1. Market state 1 is one of the 5 bullish market states. Market states 6 through 8 are 3 transitional market states, and the last 4, which are 9 through 12, are more bearish market states. And so the market state had entered, the S&P 500 had entered market state 6 a couple weeks ago following a spike in volatility. Canterbury short-term indicators have now turned back positive, taking off that volatility alert and transitioning us back into a bullish market state environment. And so if we look at a chart of the S&P 500, we can see that the market hit a low on December 24th and actually rallied back to put in a new peak on April 4th. Now, this peak in the market was followed by, an extreme move upward that had nothing more than a 3% correction on the way back up. And so you saw an extreme 20% decline from peak value and then an extreme run up with no pullback or correction. We then experienced a pullback through the month of May that drew back about 6%, and since then we've sort of rallied back. Now, just because we're in market state 1 does not necessarily mean that all things are go. Typically market state 1 can be prone to some pullbacks because 85% of new market highs occur in market state 1. Currently, we are near a new market high. And so it wouldn't be unlikely for us to see maybe a pullback or drawdown from here. Canterbury Volatility Index measures 65. CVI 65 is what we consider a rational level of volatility. That number really hasn't increased or decreased over the last 2 weeks. We saw a CVI spike back in May, and that's again what triggered the market state 6 volatility alert. But since then, we still remain below CVI 75, but we could be prone to some outlier days of about 1.25% or more, taking us above CVI 75. Volatility back in December 24th was at CVI 129 and has since declined to the current level. So the topic we're going to talk about this week is that all liquid traded securities will have both bull and bear markets. And the S&P 500 is an all equity index. It is not diversified, it is not meant to handle drawdowns. It'll go through both bull and bear environments. And our goal here at Canterbury is to construct the efficient portfolio. The efficient portfolio, it's going to be a moving target. There's going to be time when, United States equities are efficient and times when they're inefficient. There's going to be times when international equities are more efficient than the United States equities. Bonds, on the other hand, are considered to be a conservative asset, but they're going to have times of inefficiencies as well. And so if we look at a chart of bonds, which is right here, we can actually see that this is a chart of TLT, which is 20-year treasuries. And bonds actually had a peak to trough decline over the last 3 years of minus 22%. So while the equity markets were increasing, bonds were actually falling substantially, long-term treasuries. And we could see most recently, they've kind of rallied off those bottoms, but bonds haven't made any money in the last 3 years. While equity markets have kind of gone up substantially. If you look at IEF, which is 7 to 10-year treasuries, it's the same sort of thing. They experienced a drawdown of minus 12% and are basically at the same spot they were back in October of 2016. Not only that is, the S&P has been a really good index to be globally. A lot of international markets haven't experienced the same thing. If we look at a chart of emerging markets, and for that we're going to use ticker symbol EEM, this equity index is still 21% off of its old high. It experienced substantial drawdown, it did not really have much kickback, and it's still sitting 21% off the old high, while the S&P 500 is really close to its old high. The EFA, which is developed markets and excluding the United States and Canada, is still 13% off of its old high. So international markets haven't experienced the same success that the United States equity markets have. And so now, just because the United States, broad S&P 500 market is in a bullish market environment, does not necessarily mean that its individual constituents are all in bullish market environments. In fact, it's going to have some that are in bull markets, it's going to have some in transitional markets, and some that are in bearish markets. I mean, look at a chart of, IBM or GE, for instance. And so if we take a look at this chart, which shows the percentages of stocks in each sector that are in bull, bear, or transitional markets, we can see that sectors like utilities and real estate and consumer staples, which are considered to be more defensive sectors typically, have a very high percentage of stocks in bull markets. Whereas sectors like energy and healthcare have a higher, and communication services, which is going to include like Google and companies of that nature, have a high percentage of stocks that are in bear markets. And so this is just something we kind of keep track of. I believe right now about 67% or so of the stocks in the S&P 500 are in bull market environments. And then consumer staples, utilities, and real estate actually have about 76% of those in bull markets. Actually, it's 58% of total stocks are in bull market environments. And so, investing is going to be a lifetime endeavor. Over the course of your lifetime, there are going to be many different things experienced. You're going to see substantial runs in the market, as well as substantial declines. And we need a process to navigate that. And that's why adaptive portfolio strategy is so important. Being able to rotate from asset classes that are more bearish to ones that are more exhibiting the right characteristics to limit drawdowns and compound returns. The S&P 500's had a good run. International hasn't been nearly as successful, and bonds until recently really haven't done anything either. And so, as we go through this process, there's going to be many different things that happen across the course of your lifetime. With that concludes this week's market update. Thank you for listening, and have a good rest of your week.